All right, let's just get right into it. Forget everything you think you know about Tesla being just a car company. We are witnessing a complete system re-architecture. They are pivoting, and I mean hard, into a physical AI and robotics powerhouse, pouring billions of dollars into a future that has very, very little to do with just stamping metal. So let's dive in.
And right off the bat, you could see the battleground for investors. I mean, look at this. On one hand, you zoom out 5 years, and Tesla's been an absolute beast, tracking right along with the NASDAQ's tech-heavy run. But then you zoom into just the last month, and you see the pain, down to almost 8%, and it's actually underperforming the market. So what's the real story here? Is this a company that's in decline, or is it a company that's just reloading for its next massive chapter? That is what we're here to figure out.
So, we're going to approach this like financial detectives. We're going to dig through the numbers to uncover the real story behind Tesla's AI metamorphosis. This is all about rewriting the company's fundamental DNA, shifting from building cars to building intelligence itself.
And this slide, right here, it visualizes the entire strategic pivot perfectly. Everything Tesla is known for, the gigafactories, the massive vehicle deliveries, even their auto R&D, it's all now being funneled into one massive objective: building a physical AI infrastructure. And let's be clear, this is an intentional move away from those high-volume, low-margin EV price wars. The real goal? It's to build a monopoly on real-world AI compute before anyone else can even get to the starting line.
Okay, so let's follow the money. We're going to decode the financials and solve this mystery of where the profits seem to have just vanished. Because the numbers, they always tell a story.
And boom, our first clue is right here in the top-line revenue. For the very first time, total growth has actually gone negative, dropping from nearly $98 billion down to under $95 billion. The legacy car-building engine has completely stalled out. But, and this is a big but, look at that revenue mix shift. The energy storage business is scaling so fast, it's acting as a critical bridge, keeping that top line from an even steeper fall. That is a crucial detail.
Okay, so the plot really thickens when we look at the margins. On the left, you've got gross margin, and it's incredibly resilient at 18%. This tells us Tesla still knows how to build things super efficiently. The factories are profitable. But then you look over to the right, and the net margin has collapsed, down to just 4%. That has dragged their net income all the way down from almost $15 billion to just $3.8 billion.
So this brings us to the central question of this whole breakdown, right? If the core manufacturing is still this efficient, where are all of those billions just disappearing between the top line and the bottom line?
And here's your first answer. Tesla is deliberately sacrificing near-term profitability to pour a massive $6.4 billion into its research engine. Just look at how that R&D expense is scaling aggressively while the revenue line stays flat. Now, this isn't wasteful spending. This is the raw computational fuel they need to solve full self-driving and actually build out that robotaxi network.
And the second part of that answer is capital expenditure. I mean, after a historic $11 billion infrastructure sprint in 2024, they're keeping the foot on the gas with another $8.5 billion build-out. This money is buying physical silicon, Dojo supercomputer nodes, and robotaxi infrastructure. They are building a hardware moat that, let's be honest, the legacy automakers simply cannot afford to replicate.
Which, of course, begs the question, how on earth can they afford this multi-billion-dollar bet on AI without taking on mountains of expensive debt? Well, let's flip over to the balance sheet and see exactly how this whole thing is being funded.
And this is how. A staggering war chest of nearly $45 billion in cash and cash equivalents. This is their ultimate safety net. It makes them almost immune to macro shocks and gives them the freedom to invest super aggressively, no matter what the market is doing.
And this slide just lays it out, crystal clear. With nearly $45 billion in cash sitting there against just over $8 billion in debt, Tesla can self-fund its entire AI transition. There's no need to go to the expensive debt markets. They literally control their own destiny.
So this brings us to a crucial point, something we call the free cash flow paradox. You might be wondering, wait, how does cash flow actually go up when the accounting profits are going down? Well, the answer is by relentlessly squeezing working capital. By extending how long they take to pay suppliers and keeping that working capital ratio tight, Tesla can structurally engineer over $6 billion in free cash flow, even while its margins are getting compressed. This is the kind of deep dive data that really helps you cut through all the noise. And if you're finding this breakdown helpful for your own analysis, just take a second to hit that like button, share it, and subscribe to the channel for more. We really do read all the comments.
Okay, so we have all the evidence on the table now. Let's look at the investor battleground and see how two opposing camps, the bulls and the bears, can look at these exact same numbers and come to completely different conclusions. It's fascinating.
So the bears? They're laser-focused on the income statement. They see revenue shrinking, net margins getting crushed, and all that technical weakness in the stock chart we saw earlier. Their core argument is simple. This is a failing car company losing its pricing power in a really competitive EV market. But the bulls? They're looking somewhere else entirely. They're focused on the balance sheet and capital allocation. They see that unprecedented $44 billion cash hoard, the billions being poured into AI and compute, and that strong free cash flow we just broke down. Their argument? This is a necessary metamorphosis. It's the caterpillar dissolving into an AI butterfly.
So, who's right, the bears or the bulls? Well, the answer might be that we're all using a completely wrong framework to analyze this company in the first place. We really need a new way to think about its valuation.
And this scale shows that valuation disconnect perfectly. The present shows a company with negative revenue growth and really low net income. By any traditional car company metric, its 342 price-to-earnings ratio, which is basically just its stock price relative to its profit, is mathematically insane. It's unjustifiable. This is the market's bet. Wall Street is looking completely past 2025's car deliveries and is valuing Tesla as a high-margin software and AI company.
Which brings us to our final verdict. The metamorphosis is complete. The central focus now is autonomy. Trying to compare Tesla to legacy automakers like Ford or Toyota, it's a dead framework. It just doesn't work anymore. The new reality is that Tesla has to be analyzed against companies like NVIDIA, OpenAI, and pure-play tech infrastructure providers. The bottom line? Tesla in 2025 is a massive, heavily funded venture capital bet on AI and robotics, with its floor provided by a car and energy business that just happens to generate billions in free cash flow to keep the lights on while the future is being built. So I gotta ask, what's your take? Is Tesla an AI powerhouse in the making, or is it just a car company in decline? But more importantly, what companies should we break down next? Drop the actual ticker symbols in the comments below and we will get to work.